Ladies and gentlemen, good day and welcome to Mass Financial Service Limited Q2 FY'25 earnings conference call hosted by InCred Equities. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Jignesh Shial from InCred Equities. Thank you, and over to you, sir.
Yeah, thank you, Nikita, and good evening, everyone. On behalf of InCred Equities, I welcome all to Mass Financial Services Limited to FY'25 earnings conference call. We have along with us Mr. Kamlesh Gandhi, Chairman and Managing Director, Mr. Darshana Pandya, Director and CEO, Mr. Dhwanil Gandhi, Executive Director, Mr. Ankit Jain, Chief Financial Officer, and Somebody of Mass Financial. We are thankful to the management for allowing us this opportunity. I would now like to hand it to Mr. Kamlesh Gandhi, Chairman and Managing Director of Mass Financial Services Limited, for his opening remarks. Over to you, sir.
So thank you, Jignesh, and good evening, everyone. I'm very happy to connect to all of you once again to apprise you for the working of this quarter, that is Q2 25. I'll take you through the brief working of the company, followed by my colleagues taking you in detail, and then we'll be open for question answers. Friends, just to start with, we had once again a very stable and a consistent performance for this quarter, growing our assets at the rate of 22.35% on a consolidated basis, profitability at almost 25, more than 25% on a consolidated basis, and on a standalone basis in MFSL we grew our AUM at 21.71% and profitability by 27% on the back of the recent capital raise that we did in June last quarter. And even in the housing finance company registered a very robust performance with around 33% rise in AUM and 25% rise in profitability. In consistence to our working, the quality of the assets were maintained at 1.57% net stage 3 asset and 0.65 net stage 3 assets in the parent and the housing respectively. So once we are circumspect, and we saw that the quality of the asset is maintained even during this challenging period. If I take you through the products, we continue to focus on MSME, wheels, and to an extent personal loans, whereas 80% of our contribution to the asset comes from the MSME sector, and the rest 20% comes from wheels and PL at the rate of 15% approximately and 5% approximately respectively. So we will continue to focus on diversified asset mix going forward, as shared earlier also, that we would like wheels to contribute around 25%, housing to contribute around 10% going forward, and the rest to be contributed by SME and then the MEL, that is the small enterprise, the small business loan portfolio. And this will be on the back of a very strong distribution. Currently, we have 198 branches, which is slated to be anywhere between 215 to 220 branches by the year end. The centers reach has increased to 13,000. As you know that we work in a hub and spoke model, on a hub and a spoke model. Every branch will cover around 40 to 60 kilometer radius. So that enables us to serve all extend our financial services at all the centers within that radius. We'll continue to pursue that model, and so far it has yielded very satisfactory result in terms of quality and efficient distribution. In terms of our distribution through NBFC, that also remains very robust. The contribution of our NBFC distribution contributes around 34%, and 66% is through direct distribution. And as you all know that we are progressively increasing our direct distribution because of the fact that the speed of direct distribution outpaces the speed at what we do through our NBFC channel partners. So within next 3 to 4 years, we see this to be settling anywhere around 70-75% in favor of our direct distribution. In terms of liability, well-diversified liabilities, I'm very happy to share that we have been in a position to raise the liability at will, but we have taken up the challenge of raising it at competitive rates to the maximum extent possible, and also go for diversification. Currently, we have around close to 12% as capital market borrowing, which over a period of time, and as you know that our rating has been upgraded to AA- now since March. So progressively we will have more exposure through capital markets, and within the next 3 years we intend that to take to 20% as a mark of our diversification, with some contribution coming from ECB also. That will give us a very well diversified liability mix, irrespective of the fact that we have very strong support in domestically right now within our conventional means of funding, namely the private banks, public sector banks, and the DIIs like SIDBI, NABARD, Mudra and all. So we are very well placed on liability front, which Ankit, our CFO, will take you through when he takes you on through the details. Very important part which I'd like to discuss here is on the HR front. We are on a consolidated basis, we are close to now 4,000 personnel working in the group. We continue to focus on getting higher efficiencies from them, and at the same time, the optimum use of technology should increase the productivity of all the employees, reflective from the fact that we are in a position to maintain our operational costs by and large on the stated objective lines. So as far as HR is concerned, we understand that it's a task to be worked upon and can be worked out. We are constantly endeavoring, maybe recruitment, maybe upskilling, training, engagement, and creating an atmosphere whereby people get an opportunity to demonstrate their skills. And as we have been doing since long, we value dedication and honesty above anything, and that has paid us good dividends for us with more than around 500 people working with us for more than 5 years, and a very strong core team, which forms a very formidable second line. As I shared earlier, the technology will play a very important role as an enabler for efficiency enhancement. We have an in-house team of close to 100 people working. We have opted a build and operate model rather than a SaaS-based model. And I'm very happy to share that we have loan origination system and LMS at place. And loan origination system is at place for across all our products. And as a next step of development, we are trying to make it BRE enabled. And that process has started from April. Happy to share that within this quarter, we'll be in a position to launch BRE-enabled LOS across our products, while currently it is on a trial run. But that will help us to increase our efficiency tremendously because of the fact that the clients whom we serve, the disbursement to login ratio is quite low. So if we have BRE at place, that will improve the efficiencies at all levels, be it at the originator and be it at the credit decisioning levels. Talking about the current scenario, I think all of us hear a lot of news, and we have so much of information on our desk from time to time, especially on the credit quality, on the over-leveraged borrowers, and at the same time, the commentaries that still few more quarters will look challenging. While I would agree to all those facts at the ground level, but we are very confident to navigate through this situation given our fundamentals. If you see that we are a 28 years old company, we have navigated through such situation in the past. Going through such cycles in lending business is normal for over a period of some years, and we have seen this and navigated in the past very successfully on the back of right approach to asset creation. Our approach to asset creation always remain on the dictum of extending credit where it is due. While we are confident of a 20 to 25% growth, and as we have demonstrated over 118 long quarters, and that through the growth mainly through internal accruals demonstrates our capabilities to navigate through cycles and the operational efficiencies and the control on the credit cost. But I would like to share here that while we have a medium to long-term objective of 20 to 25%, we would not mind a slightly lower growth in favor of a better asset quality or a sustained asset quality and sustained profitability, while it can always pick up in medium to long term, thus not deviating from our medium to long-term objective. We continue to be vigilant on the latest development at the marketplace, but as I shared, that with fundamentals at place, lending can be a very complicated or a easy business depending upon how you take it. And we have always followed up the dictum of extending credit where it is due, discovering growth rather than just targeting growth at any cost, and that has really helped us. And we all know that there is a lot of supervisory oversight in order to bring, with an intention of the regulator to bring an orderly growth in the system. While it is a short-term pain, in the long term it will bring about a more orderly growth, more importantly because of the increasing role that is being played by NBFCs and even fintechs also entering this segment, which have a potentiality to grow big, but with a caveat that they what the regulator thinks that they should grow big with a balanced approach on asset quality customer services. So with an increased supervisory attention, we all NBFCs should be cognizant of the fact that all the operations should be more compliant, and we are also working on the same lines, that how the operations are progressively more compliant and how we are more sensitive towards the letter and spirit of the regulation. Over the years, we have added to that. We see no reason why we should not be in a position to do it, withstanding the fact that continuously adjusting your operations and at times even the business models, if required, will be the order of the day going forward. So all in all, it was a good quarter for us. We continue to have confidence in the coming quarters as we go ahead, as we have done over all these years across our product lines and across our area of operations on all the aspects of the business. I would like to hand over to Darshana to take you through the numbers in brief. Darshana.
Yes, sir. Thank you so much. Good evening, everyone. So, to start with the numbers on performance, I'll be first briefing you about consolidated numbers and then we'll take up the standalone numbers. So as shared that it was a good quarter for us, there is a growth of 22.35% in AUM on consolidated basis. That is from 9,547 crore to 11,682 crore. And as far as PAT is concerned, there is a growth of 25.31% from 62 crore to 77.62 crore. Coming to the standalone numbers, total income on, if we compare the quarters, total income grew by 23.75% from 296 crore to 367 crore. Profit before tax, there is a growth of 27.56% from 80 crore to 102 crore. Profit after tax, it has increased by 27.60% from 60 crore to 76.57 crore. If we compare the half-yearly results, total it is in similarity with the quarterly numbers. Total income grew by 23.73% from 577 crore to 713 crore. Profit before tax grew by 26% from 156 crore to 196 crore. Profit after tax grew by around 25% from 117 crore to 147 crore. If we look at the configuration of the portfolio, our micro enterprise loan grew by 11.39% from 4,260 crore to 4,745 crore. SME loan grew by 23% from 3,232 crore to 3,974 crore. There is a growth of 14% in two-wheeler loan from 624 crore to 712 crore. Commercial vehicle loan growth is 62% around 556 crore to 900 crore. And salaried personal loan, there is a growth of 83%, 372 crore to 685 crore. So we can see that in the overall growth percentage, MSME segment contributed around 62% if we compare the Y-on-Y AUM growth. Talking to you about portfolio quality, it was remained stable. That is 2.36 gross stage 3 asset as compared to 2.29 gross stage 3 asset in June quarter. And net stage 3 asset is 1.57% as compared to 1.52% in as on June 2024. Now coming to the housing numbers, the AUM stands at 665 crore. That is the growth of 32.67% from 500 crore to 665 crore. On quarterly numbers, the total income, there is a growth of around 35% from 15 crore to 20 crore. Profit before tax grew by around 23% from 2 crore 47 lakhs to 3 crore. Profit after tax, there is a growth of 24.63%, 1.90 crore to 2.37 crore. And half-yearly numbers, total income grew by around 35.83% from 28 crore to 38 crore. Profit before tax, there is a growth of 30.23% from 4 crore 48 lakhs to 5 crore 84 lakhs. And profit after tax grew by 30%, 3 crore 49 lakhs to 4 crore 54 lakhs. Here also the quality of the portfolio remains stable. That is gross stage 3 asset is 0.93% as compared to 0.90% in June quarter, and net stage 3 asset is 0.68% as compared to 0.65% in June quarter. So this was about the performance for both the companies. Now I'll request Ankit to take us through liability and capital management.
Yes, thank you, ma'am. So good evening to all. To elaborate on the liability management, we, through our efficient liability management, was able to maintain average cash and cash equivalent of around 950 crore, even after this QIP raise, and unutilized cash facility of around 300 crore. In addition to this, we have sanction on hand to the tune of more than 2,000 crore in the form of term loan, direct assignment, co-lending. In the September quarter, we did around 600 crore direct assignment and co-lending transactions. We further have more than 1,200 crore sanction on hand, which will be utilized during the year. We recently entered into a co-lending partnership with UCO Bank. This partnership will help us to further expand our clientele and provide credit to the sizable and underserved and unserved MSME customer at affordable cost. The company aims to maintain around 25% of AUM as off-book to direct assignment and co-lending partnerships. We have available cash facility of around 1,500 crore, out of which utilization remains at around 70-75%, and that portion is kept as a liquidity buffer. And during the quarter, we raised around 660 crore term loan, which has an average maturity of 3 to 5 years. Further, we have around 800 crore term loan sanction on hand. Further, we raised rupees 150 crore NCD through private placement during the quarter. We, in terms of asset liability maturity pattern, are well placed, whereby the liquidity is adequate and the cash flow in all the cumulative buckets is positive. The capital adequacy remains strong at 26.52%, with Tier 1 capital at 23.76%, and debt equity of 3.25 times. The cost of borrowing for the quarter was at 9.83%. The cost of borrowing for June quarter was 9.80%. The incremental borrowing which we did during the quarter is at around 9.75%. The cost of borrowing remains stable, and we expect to remain at the same level in the coming quarter also. So that's on the liability management, and now we are open for the Q&A round. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a minute while the question queue assembles. The first question is from the line of Ankit Gupta from Bamboo Capital. Please go ahead, sir.
Yeah, thanks for the opportunity and congratulations for a strong set of numbers in this, challenging environment. So, sir, my first question is on the asset quality. If you can talk about, are you seeing some signs of stress across, your geographies and our assets, any signs of some stress across, let's say, if we look at all our product categories from SMEs to two-wheelers and micro enterprises loans. So if you can talk about, any signs of stress that you're seeing across all these product categories, and how do we see growth, in these challenging times?
See, as submitted, our gross three-stage asset has increased slightly. So you can say that we have seen a slight stress across our product categories which we offer, including annual, two-wheeler and commercial vehicle. SME had been benign for us. So marginal increase in 90 DPD has happened, so that has taken from 2.27 to 2.36%. Despite of utmost caution exercised, this is the slight increase in the delinquencies, and going forward, we don't see an additional stress because the way we have examined our portfolio and the way we do it from time to time, we don't see that increasing substantially. While it might be range bound anywhere between 2.25 to 2.5%, as we have always been maintaining. If you remember, we always talk about range bound gross stage 3 assets from 2.25 to 2.5. That is because of the very reason that each of the businesses we saw goes through cycles, and then can be certain situations what we are going through right now. So on the stress, we would be happy if we can be in a position to manage anywhere between 2.25 to 2.5%. And on GNPS and net NPS anywhere between 1.5 to 1.75%. That is our stated objective. In terms of growth, our medium term to long term growth guidance remains intact, anywhere between 20 to 25%. We have always shared that we are not a quarter to quarter company. We don't mind a quarter of a lower growth in favor of a better quality and a sustained profitability. So we will take a call as this quarter proceeds, and then we'll discover the right rate of growth. But it won't be substantially lower than what our long-term objective is.
So, sir, that's good to hear. On the micro enterprises loan side, on MFIs, we have been hearing quite a bit of stress. The results which also have been reported in the segments for a lot of microfinance companies as well as the SFBs do reflect the pain in the segment. So for us, how are our companies where we lend to on the micro enterprise line loans doing? So if you can comment on that.
Since since last 6 quarters or so, we have been progressively tapering our exposures on microfinance companies. As I talked to you currently, they form less than 5% of our total exposure on AUM for the on loans given to MFI NBFCs. And we have been very selective on to whom we lend, and they are the ones who have gone through a vigorous test of liquidity and solvency, and accompanied by our strong on-site diligence. So we continue to be very vigilant on those fronts as far as our working with our MFI NBFC partners are concerned.
Sure. This last question on the SME front, like MFI, it seems like pretty clear that, from the statements from the RBI as well as the companies, that there has been some issues on over leveraging and the sector itself going through a tough time. On SME side, sir, any signs that you are seeing? Of course, our numbers have been pretty good, but for the sector on SME lending, if you can comment, are there any signs of stress in this area?
Hi, Dhwanil here. So on the SME side, as you rightly mentioned, and we also displayed that the overall numbers have been stable. At the ground level, yes, we are seeing some over leverage in some of the pockets. One parameter which helps us to look at this is that our rejection percentage has slightly gone up. So our policies have been kept slightly tighter since some time. So over leverage, we look at various parameters to come to that conclusion. But we are seeing that some of these SMEs have borrowed at a much faster pace. They are also growing. It's not that the growth is not coming. They are also growing equally fast, but on the back of additional borrowings. So this has to be monitored carefully. It doesn't mean that they will go bad, but because these are smaller enterprises, they have to be monitored carefully that the growth for them is sustained for them to service this debt continuously. So yes, slight stress on the over leverage front is being seen. Our rejections have gone up, but for the amount of business that we want to do, we are confident that we'll be able to weed out the good borrower. We'll be able to bring out the good borrowers and continue our growth on them.
Okay, that's good to hear. Thank you and wish you all the best. Yeah.
Thank you. The next question is from the line of Shubhranshu Mishra from Phillip Capital. Please go ahead, sir.
Hi, Kamlesha. Good afternoon. So, two questions. The first one is around our NBFC partners. So, have we changed any of our credit loss arrangements with any of our partners in the recent past? And if yes, what would be the number? And how do we look at the proportion being sourced from NBFC partners in the next 3 to 4 years? What would that proportion be? The second question was around assignment. Assignment and securitization markets are scaling new highs. Is there any pricing issue that is coming because of the supply? So there's a lot of bank portfolio also coming into the assignment securitization market now. So are we facing any issues in terms of pricing there? Thanks.
So in terms of, as I shared earlier, in terms of our NBFC partnerships, we have been quite circumspect, and the loss given defaults or the losses in our partnership business with NBFCs is on the stated lines. It has not increased substantially, and it is within the FLDGs provided to us, and they are in a position to serve the portfolio as per their obligations. So that is not creating any stress as far as our books is concerned. On the second question on the configuration, as I have shared that over next 3 to 4 years, there is approximately 70-30 in favor of our retail distribution, only because of the fact that the retail distribution will grow faster as compared to our NBFC distribution. And in terms of assignment, I think how we work, if I understood your question correctly, how we work as far as assignment is concerned, that we have a steady line of sanctions from the banks given our past track record. They take a seasoned portfolio and then an ECL is worked out, and basis that the pricing is done. And basis the quality of our portfolio, we are in a position to raise the assignment limits well within our acceptable interest rates, that is sub 10%. And as far as assignment is concerned, it is in par with any other source of funds that we raise through term loans or through capital markets. And currently we have a very healthy lines of sanctions on hand as far as assignment is concerned. If you would like to add something.
So this quarter, I think you are coming from the point where the 21% of our book is DA, but because we did QIP last quarter, therefore we had a higher liquidity on hand, and therefore we raised our total borrowing this quarter was lesser as compared to last quarter, and some part was also because we did a lesser DA, and this resulted into a 21%, 22% output. As we told, we are inclined to have a 25% of book going forward.
Understood. Thank you.
Thank you. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yeah, thank you. Good evening, everyone. So just one question. While we have articulated what the current scenario is like and how we are not seeing as much stress as some of our peers are seeing. So one thing that I was trying to understand is versus past cycles that we have seen and successfully navigated. Back then, the proportion of loans which were sourced from NBFC partners, and to that extent, the FLDGs that we had in our portfolio were maybe higher or significantly different versus our loan mix today, where a large part of the loan book today is sourced through your retail distribution, where you might not necessarily have FLDGs in place. So in what we are seeing today in terms of the asset quality environment, how would that impact the scheme of things? Or to be more precise, how could credit costs be different this time around versus what we have seen in the prior stress cycles?
So in this scenario, what happens is that when we are doing directly through a direct distribution, the loss, when we talk about a manageable stress, we talk about the risk-adjusted returns. That is, the loss that were anticipated, they are within those lines. So the numbers might look more as we progressively increase towards our direct distribution, but that will be offset by the higher yields, and that is well within our yield matrix. So whenever we were doing through our partners also, let me share here that while we were doing with our partners also, we are very circumspect of the fact that the mirror image of the portfolio should also be maintained. And we always had an idea that we don't want to benefit at the cost of the partners' losses. So the conduct as far as the credit screening is concerned and as far as the approach to asset creation is concerned has always been as if it is on our books only. So we are not finding anything new to adapt to the change in configuration when we talk about direct being increased as compared to indirect. And when we talk about the anticipated losses, I think that will be well within the risk-adjusted return anticipation as we see right now, and we are confident that it will be within that parameters given our credit underwriting. And that is why I shared that we won't mind, we would like to discover growth rather than just determine growth. And depending upon the market situation, we will be growing, and that will give us a lot of comfort in terms of asset quality.
Got it. This is useful. So, sir, the second one is more of a clarification question. You did articulate that our medium-term loan growth guidance or agent growth guidance is 20 to 25%. And in the short term, right, I mean, we will not shy away from taking decisions because of which maybe growth could remain a little lower than the long-term guidance. Then, I mean, fair to conclude that, I mean, maybe this year we are potentially looking at somewhere between 15 to 20%.
Difficult to assign any number, but it will not be that wide in range. And we will see quarter to quarter. It will be difficult for me to assign any numbers right now, but suffice to say that priority will be asset quality, profitability, and growth, while our endeavors will be to maintain anywhere between 20 to 25% as demonstrated. But what I was sharing was that we would not mind a slightly lower growth in favor of better quality and profitability. So could not assign a 15 to 20% range, but maybe few percentage here or there.
Got it. Got it. And so just one last question, if I may ask. I mean, during COVID, you really demonstrated that you indeed do not shy away from slowing down when need be. At least at this point in time, looking at the current environment, I mean, you're not seeing anything like that, right? Which will prompt you to really start going slow on business growth.
If we, as you very rightly pointed out, we will not shy away anytime, be it COVID or be it a situation where there are other triggers causing quality issues where lenders has to be cautious. So in past also we have maintained that we will not shy away from our stated objective of quality, profitability and growth. So we will take the call as and when the time comes and on a quarter to quarter basis. But as I see right now, if you see in Q2, we could see a decent growth of 22%. In Q3, maybe from a range of 20 to 25%, a few percentage here or there if needed.
Got it, sir. This is useful. Congratulations on a good quarter and wish you and your team the very best. Thank you so much.
Thank you.
Thank you. The next question is from the line of Shripal Doshi from Equirius. Please go ahead.
Hi, sir. Good evening, and thank you for taking my question. So my first question was on the NBFC MFI portfolio that we have, which constitutes closer to 5-6% of the total AUM. So how is that book shaping in terms of asset quality? And then have there been any slippages there, or how is the asset quality trend there particularly?
See, just having 5 to 6% speaks of our stringent quality parameters that we apply while onboarding any of the NBFC MFIs. And that stringent quality parameters has resulted into a satisfactory performance of all those MFIs. So we are very confident on all the few MFIs whom we are working with. And the natural risk hedge is the percentage of the portfolio constituting by lending to NBFC MFIs has reduced significantly to less than 5%. And within those, because of the stringent checks, we are quite satisfied the way they are doing.
Okay. So, okay, got it. And sir, since you highlighted in your commentary that you see that there is some stress in the on ground conversations or aspects that you track. So just wanted to understand what are the key indicators that you are tracking at company level, which is leading to the conclusion that you are coming to.
Yes, what is told, one of the striking parameters is that our logging to disbursement ratios, our rejection ratios. And based on that, we come to know about the ground level situations of the borrower. And depending upon the information that we collect through various sources, through our local credit, through credit scrubs from time to time, through the behavior of our portfolio, the early delinquency signals, we decide the credit parameters from time to time, and that is what leads us to believe in what we believe, that for a particular product we need to tighten the screens, or for a particular product the things are benign, and depending upon the region, depending upon the product, that is the decision taken on a very continuous basis by credit risk origination and collection in tandem, and those are very dynamic processes.
Got it. And then you also highlighted that BRE enabled LOS would be implemented across all products. So is it already getting implemented, or is it at still pilot level?
We are doing the sandbox of the same, and the results are quite satisfactory. And I think by this quarter and we'll be in a position to implement in majority of the product. But when any new application is adopted, it takes its own time for a full-fledged results. So I think within this quarter it will be implemented, and within the next quarter it will be yielding full-fledged results. And on BRE, as I told earlier also, that we'll be using BRE for no-go in order to reduce stress on the system, be it the originators or be it the credit decision takers.
Got it, sir. Thank you so much, sir, and good luck for the next quarter, sir.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your question to 2 per participant. The next question is from the line of Hardik Doshi from White Whale Partners. Please go ahead.
Yeah, thank you for taking my question. In terms of the constituents within the loan book, right? I mean, we've always been growing the micro enterprises loan slower than the rest for a few quarters now. So when you talk about a potential deterioration, I assume that would mainly be coming from this segment, while the other ones can continue to grow at the current trajectory.
See, we have stated this earlier also, that as we grow our balance sheet size, we would like to move more towards SME and more towards higher ticket size rather than just sticking to the lower ticket size. If you say our MEL average ticket size is around 60,000 rupees individual loans, which are banking-based assessment and banking-based disbursement and banking-based collections only. But this has been our strategy since last 6 to 8 quarters. If you see since last 2 years, our SME book is growing at a faster pace as compared to our MEL space, despite of the fact that there was no evident stress in the system as far as MEL is concerned. So this is more out of our strategic intent to move towards little higher ticket size, grow along with the borrower, and while MEL will play an important role, but its growth on a larger base will be lesser, not because of the credit quality issues alone, but because of our strategic intent to move towards higher ticket size.
Got it. But is it fair to say that the incremental stress that you're talking about in the system, is it mainly in the micro enterprise loan, or are you seeing it in other segments as well?
It's evident in the other segments also. The slight increase what we saw this time is evident from MEL two-wheeler commercial vehicle across segments, because more or less we serve to the informal and the middle income and the lower income group of the society, and whatever they are affected by various factors, that is across board. So it is across board. Whatever the slight increase is across our products.
Okay. The other question I had is, while on the micro enterprise loan, I know that the small sub-segment of that is MFI, and that is also through your partners. But, if you look at the total number of customers or the profile of the customers that you have, how many of them would be in the same category, where you would have given them an individual loan, but they would pretty much be also participating in the MFI loan?
Our MEL loans are individual loans and around 1 or 2 notches above MFI. But even then, say for example, they have a male member, we don't insist on only women borrowers. So male member might have taken a loan, and so as the women borrower joins some JLG group. So I think there can be an intersection of close to 25 to 30% of such borrowers.
25 to 30%. Okay.
Yeah.
And, on the MEL loans, what has been your loss given default? Because these are collateralized loans, right?
Which loans? MEL. MEL loans are not collateralized.
Okay. So there is, what is the overall loss given default on this historically?
Historically, LTD revolves around 40% as far as this class of the borrowers are concerned. Because what happens that as per the extent RBI guidelines, we have to mark them NPA on a daily basis. But the borrowers will be served once they go 90 does not necessarily mean that they will not pay. The only thing is that we have to follow them up and get the payment. So according to our historical data, we have been getting, we have been losing close to 40%. So LTD stands at around 40-42%.
Got it. Okay, and just one last clarification. So from what I understand, if things were to get worse, you would not shy away from slowing down the loan book growth. But as things stand in today's scenario, you're saying it is 20 to 25% kind of loan book growth with maybe a few percentage points up and down, right?
Let us take a medium to long term view. So as we have always shared, we are not a quarter to quarter company. We don't judge things on a quarter to quarter basis. So medium to long term, 20 to 25% stands. But in some of the quarters, if you have to navigate very tightly through the situation, it might be a couple of percentage here or there. That is what I was trying to convey.
Yeah. Okay. All right. Thank you. Thanks so much.
Thank you.
Thank you. The next question is from the line of Sarvesh from Maximal Capital. Please go ahead.
Good afternoon, sir. So just a few questions. One is, for your HFC, I've seen some slowdown in terms of the growth rate that we were doing, and also the NPA levels, which are, of course, small as of now, but they have been sort of consistently inching up. So any comments on these two? And are you seeing this stress also in the affordable housing space, what you alluded to in MFI?
See, if you see our earlier commentary, we always maintained that we'll grow anywhere between 30 to 35%. So this time we have demonstrated a growth of 33% on a YOY basis. So that is in lines with our stated objective. In terms of the asset quality, that will be range bound. Because we saw the informal class of the society and we have always given a range bound target. So if you say it is still at the lower end, if you compare the industry standards, it's a net NPA of 0.64% after providing on a gross NPA of 0.96%. I think that is well within control, and we see this range to continue. We see that as the portfolio matures and as the size increases, the GNPAs will range anywhere between 1 to 1.5%, and NNPA can be anywhere between 0.5 to 1%. That is well built in the yield matrix.
No, so GNPAs are of course range bound. So I mean, we don't see any any red flags from that, but it has been inching up consistently. So do you see? I mean, if you look at your gross stage 3, I think that has been inching up consistently. So do you see any trend there, or is it? What is causing it to increase consistently, although it was at a very low base earlier?
That is characteristic of housing finance, that as the portfolio matures, some of the stress can start crystallizing over a period of time. So this is the impact of maturing of the portfolio from time to time. So we started from a gross NPA of 0.5% to right now, as the portfolio matures every quarter, we are seeing some increase in the stress in the GNPA levels. That is well within the anticipated on the anticipated lines. The reason is the portfolio maturing and the stress crystallizing.
Understood. And sir, one question pertaining to a previous participant's question. So now, as we are moving more from the wholesale business to doing it on our own, so earlier, these were sort of built in the interest rates that we were getting, which were lower. And probably we would have also seen that the interest rates that we were getting, subtracting for the possible losses, is possibly that difference was higher than what our normalized losses were. So was that also a reason to move more towards our own business?
In fact, working through intermediaries, to be very honest, gave us an edge during the stressful time whereby the intermediaries used to bear the losses. When we do directly, we have to be more circumspect. While as I shared earlier, we were circumspect also when we are working through our partners on the mirror imaging of the portfolio. We never wanted to profit from a partner's loss. But as I have told many times, that the reason for the recalibration in the configuration of direct versus indirect is the result of the direct growing at a faster pace as compared to our indirect distribution. We were 90 odd branches. We are now 198 branches. And we'll be doubling our branches within the next 3.5 years. I don't see that sort of growth through our intermediary channels. While in absolute terms, the business will increase with them also. We have a fantastic experience with them so far. And we would continue to do business through those channels also. But there will be a recalibration in the configuration of the business we do because of this very reason.
But net, sir, do you foresee any impact on our ROAs now that we are doing significantly more business through direct, and wherein now all these losses will have to be bared by us, although we will get more interest, but net, do you see any benefit, or is it going to be similar, especially given the challenging scenario?
So we have been cognizant of this fact right from the word go, and we have designed our models, both the models, in such a manner that one model does not cannibalize the profit of the other. So irrespective of the distribution channels, our ROAs will be range bound anywhere between 2.8% to 3%. And whether we increase our direct distribution or whether it is more through our NBFC channels. So that is the pricing, and the operations are planned accordingly.
Understood, sir. Thank you and all the best.
Thank you. The next question is from the line of Nikhil from SIMPL. Please go ahead.
Yeah, thanks for the opportunity and congratulations on good set of numbers. Most of the questions have been answered. Just one question. Now, when in this scenario, I hope I'm audible.
Yes. Yeah.
Yes, you are audible.
Just one clarification or understanding. Now, in this scenario, when there is some kind of a stress, which overall at the sector level people are talking about, how does our branch opening rate gets rationalized? So, because we had one set of markets where we were always present and another set of markets where we were trying to enter. So between these two segments, how does the branch opening network rationalize, and how would it have an overall impact on our costs, incremental costs?
So, Dhwani here. So our branch network planning is done sometime in advance. So we already start our recce, a few quarters before we are planning to open up a branch or a center. So I think the overall branches that we have planned for the year, we'll go ahead with those. We don't see much of a challenge there because our due diligence is already being done. The markets are there for us to enter and get the kind of business that we were anticipating. Yes, the overall tightening wherever we do in the credit policy will be applicable to those locations as well. Anyways, whenever we start a new location, we go slightly slower anyways. So it's not that we'll be going very aggressively on those new locations. We'll try to understand. We'll be a little more careful, but at the same time, I think as per the plan, we'll keep on opening the branches, which are planning to add around 10-15 more branches in this financial year. And we'll go ahead with those. Cost-wise, manpower for us is the major cost. Asset-wise, the branches are pretty asset-light, so that is not that big of a cost factor for us. Manpower recruitment across all the products is something which is important, and I think that is already built in our overall planning.
And just a continuation here. So, see, when you build a model of the branch turning profitable or breaking even, because you've been operating over the last 12 years and you've seen this cycle multiple times, it's unlike what it was in COVID. So, how does the branch break-even networks or periods get extended, or generally we are able to manage in the same periods? Just from historical background, how does our assumptions change?
So historically, we are a multi-product company, so depends on which product we introduce there first. But the average range for the branch to break even would range anywhere between 6 to 9 months. That the branch would start, breaking even. In current scenario where maybe things at a macro level are slightly slow, this 9 months can extend to say 12 or 15 months. So depending, again, it's very location specific, so might get slightly longer, but the core objective with which we started that branch, the way we want to penetrate that demography remains the same. So that I think we don't have too many branches going on opening up on a parallel basis. So that is a cost that we can absorb even if few of the incremental branches take a little bit more time to turn profitable.
Okay, sure. Thanks a lot. Thanks for that.
Thank you. The next question is from the line of Srishti Jagati from Ambit. Please go ahead.
Hi, am I audible?
Yes, you are.
Good evening, sir. Thank you for taking my question. Largely, my questions have been answered. One is on account of your experience in terms of going direct. How has the experience been in largely, if you could cover as to how slippages would be divided and credit costs would be divided between the two methods of doing the business. And secondly, sir, if you could talk a little bit about, although the salary segment has grown well, the ticket size has been coming down, average ticket size. If you could talk a little bit about the customer profile here and what all geographies, if you are seeing any stress, what all geographies are under pressure.
On your first question on our experience of doing direct, like to share with you that we have been a specialized retail company since decades. The only change we made post 2011 is where we saw a lot of scope working through NBFCs as intermediary channel and that by bringing about a very efficient last mile delivery of credit. So we are not new to retail credit distribution. So our experience and our learning is of years and decades together as far as the retail distribution is concerned. The only thing is that we had shifted we had planned our distribution through NBFCs also since 2011. On the credit cost front, as I've shared earlier, that when we work through NBFCs, the rates are so decided whereby their operational cost and credit cost are built in the rates we share that we charge from the end borrower, and whatever excess, whatever they save is their excess gain, and whatever higher losses is their contribution from their profits. So that is how it has worked so far. When we do direct, we built in those losses in the risk-adjusted return metrics. So the yields are so designed and then monitored very closely on a quarterly basis to make necessary changes so that we remain steadfast within those metrics of risk-adjusted returns. And this is how we tell that we will be evaluating the growth and we'll be prioritizing quality and profitability over growth. And what was the last question?
So it was on the salary personal loans, ticket size coming down and the customer profile there.
So salaried, in fact, talk about the customer profile, they are all salaried individuals earning anywhere between 25,000 rupees to 1,50,000 rupees. The reduction in ticket size can be attributed to some tighter screening of as far as the credit is concerned. And as of now, we don't see an visible stress at any particular pocket. Having said that, that portfolio is very less. It is hardly 5 to 6% of our total AUM. But even there, we don't see any substantial stress or a noticeable stress in any of one of the regions.
Right. Makes sense. So, just a question on the new product launch. The last time around, you had mentioned that there was some working being done on used vehicles being launched, and it was in the pilot phase. I would like to understand if there has been any progress, and how do you see this rollout, if at all you do?
So, because of the lack of the getting the desired manpower, I think we will be in a position to launch it in first Q4, because in Q3 we'll be building up the team. We tried building up the team in last 2 quarters, but could not succeed the way we wanted to do it, which suits our culture and which suits our way of working. So we are rebuilding that team, and I think we will start booking business as a special vertical from Q4, hopefully.
Understood. Thank you very much.
Thank you. As there are no further questions, I would now like to hand the conference over to Mr. Kamlesh Gandhi for closing comments.
So thank you so much, everyone, the team InCred and all, and thank you to all the participants. I hope that the answers would have satisfied you, and please feel free to, for any of the queries, to be addressed to our IR department. And as a closing comment, we remain confident of a quality and a consistent growth going forward. As I've shared that on a medium to long term view, we hold on to our confidence of 20 to 25%, while we would take a quarter to quarter view as required. Thank you so much.
On behalf of InCred Equities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.